Hello, everyone. Welcome to Smartkarma's Webinar Wednesday. I'm Michael Tegos. Today, I'm excited to welcome Devi Subhakesan, who will discuss disruption in Asia's restaurant sector, which is currently struggling to overcome the brutal impact of COVID-19. Devi is an equity analyst with an Asia consumer sector focus. She has been part of buy-side and sell-side institutions and has covered oil and gas, media, textiles, consumer discretionary sectors across ASEAN, India, and North Asia. As always, some housekeeping before we start. You are very welcome to send questions for Devi using the Q&A button on your screen. Please do not reshare or reproduce the contents of this webinar without express permission. We will have a recording of this webinar available on the registration page afterwards. And with that out of the way, Devi, welcome to the webinar.
Hi, Michael. Thank you. Thank you for hosting this webinar. It's a pleasure to discuss this report online as well. This was part of the Smartkarma original series. And let me start off by saying what was really original about this report. This is something I had not disclosed in the report itself. So most of the insights I have discussed in this report primarily came from my interaction with an established independent restaurant in Singapore, which I have been visiting for nearly 14 years and has now been taken over by a private investor group. So that's where the entire disruption story kind of unraveled in front of me. And a little prelude to that, my understanding of the restaurant sector itself is backed by my own experience running a restaurant, owning it for 1 week, to be precise, many years ago. So it was an exciting and I would say quite an exhilarating experience back then when I was in my early 20s. But what I learned back then from this whole experience of managing the restaurant is that a success formula for a good restaurant is pretty straightforward. You serve good food at right prices, hire good people, have a good location, and a fairly good ambience. So it's quite simple, but the flip side is that isn't the secret, and too many people think that they can do it right, which means the entry barrier is quite low, and the industry has always been highly competitive. But what we are trying to do in this report, or rather highlight in this report, is that contrary to public perception that COVID-induced disruption is hurting this industry, we are highlighting that it has happened, it started much earlier, a few years earlier, in fact, when digital and delivery platforms came in and started disrupting the whole ecosystem, started weaning away dine-in customers away from these restaurants. So this kind of mothballed and has come into the current situation where when COVID struck, restaurants which were kind of learning how to manage the earlier disruption were left with no way how to handle it further. We will discuss each of this in detail, but let's see how this sector looks per se. So globally, this might be the picture quite, for most markets. That the data given here is for China, where 90% of the market is highly unorganized. We're talking only 10% are the chain restaurants. So here they define chain as in a restaurant group with more than minimum 10 outlets. So the entire listed space we are talking about is within this 10%. Which again is further divided into quick service restaurant and casual or sub-dining. So the independents dominate the sector, which makes it a highly unorganized sector. So this contrasts very starkly with the delivery platforms, which are highly organized. Most markets have just 2 or 3 big players in that segment. Now, how has this digital and delivery platforms disrupted this sector? Let's look at a real life scenario. Now, if 4 friends walk into a restaurant for dinner, typically a waiter would greet them, hand them over the menu, and take the order for drinks. And if each one of us asks for just a juice or a soda, you're still going to pay at least $15 to $20 for 4 of you just for the drinks. I mean, I'm talking about a mid to a lower high-end, mid to high-end restaurant where you would, go for a weekend dinner. Now, once the dinner and once the drinks are served, the waiter would probably try to take the main order, where he would try to guide you towards what they probably think is high margin for them, or prod you to try a starter or a dessert or a coffee. And at the end, he'll give you a bill which may have 5 to 10% of service charges. At least in Singapore, they do. Some markets like India, they don't, except for the high end. And you may still pay a tip on top of the service charges. But the same order now shifts online to a third-party platform. Think of how the scenario will change. First, you're going to lose that $15 to $20 bill from the drinks. And drinks, mind you, is the highest margin of all the orders you place, because typically for 4 guys, you would just cost the restaurant $2 to $3, or that's $5 to serve a non-alcoholic drink. So gross margin of $10 from that order is right away wiped off. And then there's no service charges, there's no tip, there's no dessert or coffee from the same restaurant. And to top it all, the restaurant is gonna pay 30% of this bill to the platform. I mean, that's a killer, because if you look at our listed space, almost no one makes more than 10% net margin. And here we are saying 30% has to be paid off to the platform, 10% for order aggregation and another 20% for delivery. Doesn't matter if your bill is for $25 or $250. So this is where the restaurant industry was totally lost, because the customers not coming in for dining and then ordering for takeaway. When you are running a model which is mostly focused on dining and you have to deliver, it just wasn't working out for them. Now COVID struck. This is a survey result taken out in March. I've used it basically to highlight what are the lifestyle changes that were that were coming out. Totally out of health cautiousness, I would say many of us stopped dining out. It's not because we didn't want to, but you just thought, why risk yourself? And then in many markets, dining was not allowed, only takeaway was allowed. So you stopped dining out because of social distancing. And then because of work from home, you would anyway, then the lunch orders which you used to, the restaurants near CBD got in, that's gone away. People started, there's very little of travel and tourism. And if you look at it, if you see the ordering of grocery too went up. So this lifestyle change kind of worsened the impact of the existing disruptions, which was already underway. Now, the first few months, starting off from March to April, till I would say till last month, and continuing even now, is that your dining demand has declined because off-premise dining is now being increasingly preferred. That's not how we led our lives. We loved going out. We saw dining into a restaurant as a fun experience, at least in Asia, this part of Asia. Or you went out with friends, we went out as many families together. But now, you kind of got used to this new lifestyle where you would rather sit at home, watch Netflix, and eat out of that delivered box of out of the delivery box itself. Secondly, the norms that were set by the authorities, it varied from city to city, reduced the number of seats that you could offer. Either it was the number of seats per table or the number of seats based on your square feet. So some of the places, they had to cut down up to 30 to 50% of the dining capacity just to adhere to the norms. And again, on top, you had no dinner being served after 7, sometimes after 9. So this kind of changing norms was not something most independent restaurants could handle, and catering used to be a big part of their overall demand. With no social events or limited social events, that business is totally off. Rents along CBD area is probably the highest in any market. So those restaurants, coffee shops, which rely totally on office goers, were totally out of business almost, because the work from home comes initially out of force, and now many offices offering it. There's hardly, the footfall is much lower, which I wonder how they would, balance their costs with that. This overall revenue and margin disruption fall, which has occurred due to COVID, and the disruptions in operation that happen in between, is way too much for most independent operators who anyway didn't have the balance sheet strength. Now, what are we seeing going forward, or what's happening right now? The independent restaurants are left with not many options. Either you try to adapt, or you close down if you don't have the money, or let yourself be taken over. Those who have some kind of bargaining power with their tenants would try to restructure and renegotiate the rent downwards. Rents are obviously falling down. But from what I hear from the industry, the smaller guys aren't getting that advantage. The tenants and landlords are still saying, no, we would get another guy, you might as well move over. The larger guys are a little more better placed, because even if you look at the listed space we're talking about, be it Yum China, they have all plugged in Haidilao, Geoma, they have all plugged in a variable component into their rental agreement. So, they are better placed in that, how the whole scenario is adapting. The larger guys also have the advantage of having their own digital and delivery platforms. So if you look at Yum China, they have one of the largest loyalty programs. Nearly 30% of their sales the last quarter was online. So even if they get the order online from another aggregator, they're able to use their own delivery channel to deliver it. They are in a position to relocate to a different space, cut down where the demand is lower, the size of their places. And something I didn't discuss in the report now, and something that has come up later, is one of the ways some restaurants are trying to adapt is use technology. So Haidilao has always been talking about using their intelligent arms and having a smart kitchen, but now they have gone ahead and deployed nearly 900 robotic waiters. It is a little surprising, because Haidilao is a place which we associate with the kind of customer delight and employee interaction, especially the service staff interaction. So for them to go and adopt robotic waiters, does it make sense? Does it gel with their strategy? But given the current times, I think many customers or patrons would think lesser people touching my food will mean, it is more hygienic, lesser chance of infection. So that is one way in which restaurants are trying to adapt. We would know how it will work out in the long term. Cost-wise, it may not make too much sense in the near term, but it depends upon how they have negotiated the cost. But in the long term, obviously, that should be an advantage. But as is the way some of the restaurants are going to evolve, it fits in with some models like Haidilao, where there isn't too much of specialist cooking, because it's hot pot, you just need to deliver specific things from the kitchen. So that's the way some of these restaurants are trying to adapt. Alongside, we are talking about competition from cloud kitchens. So it's an independent restaurant with a dine-in focus will find it difficult to compete with a cloud kitchen who barely have any overheads, and they probably operate out of an industrial sector where the rentals are very low, and they have all the economies of scale in case of the supply chain. So going forward, if a well-known chef decides to run a cloud kitchen, would I order from him? Yes, because I'm assured of quality, I'm quantity, I'm assured of quality, and the kind of the price advantage which he will have will probably kind of pass on to the customer. So the cloud kitchen scenario is still evolving, but it is going to be another threat to industry as we see today. Lastly, we come to this question of, it's one thing to say there's no dispute about the fact that the sector has been impacted by the disruptions. But another question is, has overall demand for restaurant-served food shrunk? Does that mean, has the industry size gotten smaller after COVID? Because, any crisis or not, the demand for food shouldn't change as long as population is same. It just changes how it is sourced and where it is consumed and what is consumed. So the value, how this gets divided between the participants might change, but the overall pie shouldn't change much. So though I am a bit of a view that's a part of the market has shrunk in the sense that when we look at data on consumer spend in retail on grocery, which has been in double-digit growth over the past several months, beginning from April to July, suggests that consumers are continuing to buy more of fresh food, which means they are probably continuing to cook some food at home. It's not, cook more now than they did earlier. Likely, given they spend more time at home, if you are working from home, you have very little of leisure activities outside. It's possible that you spend more time at home and then you tend to cook more at home. But overall, I would think those who were eating out would want to or continue to order from outside or go out and eat. So the market has shrunk, but may not be significant enough to dislodge it. But within that, some players will do better versus other, given how this value is going to get divided in this change scenario. That's how we have looked at, who are the winners and losers of this disruption. For now, it's clear there's going to be the organized players are going to garner more market share as more independents close down. They're going to have some cost advantages in terms of renegotiating rental agreements. Those who have their own digital and delivery channels have better margin protection, but you can do that only if you're a big guy like KFC or like McDonald's. And we prefer QSRs given the macroeconomic headwind isn't positive. If customers may get more value conscious about how much money you spend on food buying from outside, so they might tend to go for more value. And given the overall health cautiousness still in air, trusted brands will have a better advantage over others. So that's our thinking in how we have sorted the, who would be the gainers of this disruption in the industry. Now let's look at the listed space in Asia and also players, the global players who are based in Asia. First, we have the global players who are there. You have Yum China, Starbucks, and McDonald's. We prefer Yum China. They have been quick to adapt to the changes. Nearly 2/3 of the restaurants stayed open even throughout the peak of the COVID times in China from February to March. They didn't have to close down, they could manage it around. And by April, almost 99% of their outlets were open. I don't think anyone has managed to come back so quickly into operations. They have a very strong brand. Given the kind of challenges we discussed, I think they are best placed to recover their earnings and revenues ahead of others. So from a 2021 perspective, I think Yum China has a better chance of bouncing back in terms of operationally than any others. The concern on the stock probably would be growth. They already have nearly 10,000 outlets, but KFC is the most prominent. They're across 1,400 cities by now. So the new acquisitions are in the Chinese dining space. So how will they manage growth? How will the acquisitions work out? If they're going to be a 5% growth company, or can they increase the growth? So that's where I think the challenge they will have on valuations. But for now, the valuations are not, packing in any kind of high digit growth. It's more in line with the established players like Starbucks and McDonald's. I'm looking on an EV to EBITDA basis. Starbucks in China, the management sounds very optimistic, but I find it difficult to accept their argument that by adopting Luckin's playbook, suddenly they can recover their revenues, because Starbucks was positioned and the management consistently talked about being the third place. It's all about community, it's all about connecting. And it was always seen as the cool place to be seen in. It was not a place where you order food, your coffee in. So it was the location, it was being seen at Starbucks that was more valuable than drinking coffee from Starbucks. So now they are attempting to pivot the whole disruption by delivering coffee. We would wait and see how it works out in China. But in the US, they have recovered sales in most places through drive-ins. So that's a different dynamics that's happening there. But now in this discussion, we're specifically looking at Starbucks China. So I would be a little cautious, but management doesn't sound cautious as of now. I would say they're mildly cautious, more optimistic. But McDonald's China management has been openly cautious about it. They have highlighted how the economic recovery is slower. Those which they're finding it in their sales recovery, and they think heightened competition from a local independent Chinese cuisine is giving them a competition. So that's where they stand. And being a single formats diner, unlike Yum China, which even within KFC they have very smartly adapted localized menu throughout, and so it's just a different positioning, I would think. So we clearly think Yum China has an advantage over the other two. This is the local cuisine scene. Haidilao, Jiamijiu, and Siabu Siabu. Here, Haidilao and Siabu Siabu are hot pot restaurants. Jiamijiu is more a concept. Actually, all three are concept restaurants, because they don't have multi-format, two hot pot, and other one is more pickled spicy fish. But the spicy fish part is doing well. According to the latest results, the Thai restaurant chain, they have managed to grow consistently, while they're closing down the original Jiao restaurant outlets. So though according to the discussion on disruption, I cannot be positive on restaurants which cannot pivot well to delivery, because delivery is the mode of recovery. Jiao in the last quarter, the latest results which they published after this report was published, has come up and said how they have started delivery for their Thai restaurant. Earlier they didn't have restaurant delivery for Thai. So they are, to my mind, they are doing what they can to pivot well. And the management, credit to them that during the crisis when they had to raise money, they did a placement, and the promoters sold their personal stake and bought shares in the company at the same price. So he injected capital into the company. without going to the public. So, there is some sort of integrity, I thought, and show of conviction in the model from the management side. There was a minority investor stake sale in Heidelberg during that time. So contrasting to that, I thought Giamigio, in some way, I thought, they're doing what they can to pivot better. Heidelberg, I'm not convinced how operationally they can pivot, because it's a restaurant which is unlike any restaurant any of you would have ever gone. The way they model something which others couldn't copy by offering this customer delight, right from the popcorns to the free ice cream. It's unlike anything you would have ever tried. But I cannot see value in getting the same food delivered at home. I tried the app. It looked like, apart from the soup, I'm ordering from a high-end grocery store, because it's all like mushrooms, sliced fish, sliced meat, all chilled and raw, So you would wonder, why would I order it online? And then it's in no way a low price place. It's a high-end restaurant if you look at the average spend per customer. So pivoting via delivery, to my mind, doesn't work well for Heidelberg, but what they're trying to do is pivot through technology in some way. That is the smart way, that at least they're trying to do something smart about it. And market has always loved the stock. The stock has done excellently well too. So, but operationally and based on my understanding of how this sector is evolving, it is difficult for me to see right now how the Heidelberg can recover its earnings fast enough by next year. You probably will have to wait for the impact of COVID-led issues to die down. Café de Coral is a beaten down stock right from the beginning, thanks to issues in Hong Kong. But given its dominant market share there, it's ubiquitous. It's all over the place. It's low value. It's a value for money player. I think that has a better chance of recovery in top line, and if they manage well the bottom line as well, as the macroeconomic headwinds over the slower economic activity kind of starts eating into customers' wallets. That's both valuation and this angle made me go positive on the stock. Lastly, the two markets I covered was India and Philippines. Let me first talk about Jollibee Foods. To me, this is like the pride of Asia. This is the only QSR brand that has ever made it big, that was totally Asian. All the other QSR brands that we talk about are totally Western. So here is a purely Asia brand. Quite inspirational how they started a family restaurant, made it so big. The food is served across the world. What kind of went wrong right now is the ambitious promoters who wanted to go global to acquisitions. So they bought a coffee chain, they bought chains in the US, and the balance sheet is weak. So if you look at from balance sheet perspective, it's quite on a weak wicket. So and in a downturn in a market like Philippines, I cannot expect more spend on eating out. Those are markets where people eat out as a luxury, as a special. It's not like you don't go into a dine-in restaurant and just like that order food every day like you would do in a developed market. Although the value per meal may be lower. So I think the macroeconomic headwinds will hit harder in developing markets, and Jollibee could be a near-term victim of that. Though I would trade the company and its growth very commendable. Coming to Jubilant FoodWorks, that's the most prominent and probably the only listed restaurant stock in India of this size, and it's Domino's. They have the Domino's license in India, and they have managed it superbly well. They have excellent growth track record, margin track record. The operating margins are probably the highest in the industry. And I expect the sector consolidation to happen quite steeply in countries like India, where there are very many small independent players with very thin, very weak balance sheet. So organized players like Jubilant will have an advantage, and they're very quick to recover from the COVID-led disruptions because they predominantly run on a delivery model. They have very little dine-in demand. So, then the stock has always been expensive, and the outlook, because of the growth outlook and the high margins, I still, would say I would be positive on the stock. Michael, if you're still there, I'll be happy to take any questions you have.
Absolutely, and thank you very much, Devi, for this very thorough presentation. We have quite a few questions from the audience, but we're also a little bit pressed for time, so I'll try to get through as many as I can a bit faster. So there are a couple of questions on which segments have been most heavily affected and whether online delivery would be enough to offset the drop in dining customers, which I think you have already kind of touched on in previous parts, specifically mentioning the winners and the losers of this situation. One question that I wanted to focus on a little bit was, do you see some F&B segments being stronger than others in rebounding once the COVID crisis is over?
I mean, how do you define the COVID crisis being over? If it's life back to normal, if it's life back to normal as we knew, and all of us go out and eat out, you don't have to wear a mask, you socialize as you normally do, then I would think, the dine-in focused restaurants should bounce back, strongly, given where they are right now. So the ones that are worst hit right now should bounce back faster, because others, like now the QSRs, the quick service restaurants, aren't as badly affected as the dine-in focused ones, because they're low value. They have most of them have managed to pivot to delivery using their own apps. But the standalone restaurants or even the chain restaurants which are focused on dining experience, to my mind, they should bounce back strongly if and when life goes back to normal. So there are two camps on this. One camp says even if things go back to normal, a lot of customers might just get used to eating at home and prefer staying at home. That's a little dim view of the world, that at least for people who are used to a different world. But when you look at the millennials who are so happy looking on the screen and eating by themselves, maybe that's what they would prefer. So it's still a little a mute point. It depends on how long this COVID crisis lasts, to my mind. If it lasts longer than a year, I think a lot of things will change further. The next generation of kids, maybe just, I'm not saying generation, but just like those who turn from 16 to 18, probably they'll say, no, it's not cool to go eat out anymore, or something like that. Or another pandemic is coming. I don't know how it will evolve. But it's a call you have to, in your mind, you have to decide, okay, if life's going back to as we lived earlier.
So, that will be something to see, yeah. And I think it stresses the point that we really don't know how things are going to evolve and what the long-term impact is as things change day by day, and the overall impact is still very hard to measure.
Yes, that uncertainty is what's driving most restaurants out of business. If they had a fixed view, okay, in 2 months things will look good, then I can take that hit. But if it doesn't happen in 2 months, if it doesn't happen in 4 months, what are you supposed to do? And that the landlord is not the kindest guy you have. So. So, and the past 3 months, we have not seen such aggressive shutdowns because in most markets, developed markets, governments have been offering some kind of support, be it the West or be it in Singapore. In India, they were giving loan moratoriums. That means you can defer your loan payments. So now that it has stopped, we will see in the next 3 months how the scene evolves. Now, even if you drive down the city, you would see many of the hoardings being taken down, many familiar restaurants having shut down for good, in the sense they have removed their banners and posters out. Oh.
Absolutely. There's another interesting question. Does the shift to digital and to the online business make due diligence on the F&B sector harder? How does an analyst kind of go on to look at a business without having the sort of on the street access of information on dine-in, on numbers of customers? Do you think that we will see more situations kind of like the Luckin Coffee debacle, for example?
That's an interesting question.
I guess it does make things a little more challenging.
Yeah, see, all this was possible because of investors. Okay, let me tell you. When no promoter has any intention to defraud you by cooking up numbers, but when you have investors giving you money at negative rates or saying that you keep it now, I am a private equity guy, I need this only after a few years, and then the promoter thinks of whatever innovative ways to multiply this, or when he can access markets and without so easily and get money. The undoing of the restaurant industry has a lot to do with the kind of funds that went into this industry, because there isn't too much of technology here. The best restaurant you would have gone to is where you love the chef or the kind of food you made, or kind of food he made. But instead, when you have investors pulling money in, then all this complicated, you need to have chains, you need to have, it's not, if you have 100 outlets or one outlet, it doesn't make a difference to me, it makes a difference to the investor. As a patron, for me, maybe the best restaurant to go to is that little place which serves, freshly bought, locally sourced food. But for investors, you need to have scale, you need to have technology, you need to be doing other things which really doesn't add value to the end customer. This is different from a grocery online guy who with economies of scale can give you better service. But in the food business, it doesn't happen that way. You're doing all this manipulations to give greater return to investors. I'm sounding like a socialist Marxist, but I'm sorry about that. But having run a restaurant, that's a bit of a personal view, So
yeah, I understand what you mean.
Defraud using these systems? Of course you can, given how we learned so painfully with Luckin.
And I guess, yeah, it eventually it catches up, I think, and pretty badly as well.
Yeah, but it is not an easy entry because you trust some brands. It's not like it's not unlike coffee. You don't try out a new chain of food restaurant that came in, like Jollibee, which is the food player from Philippines. When they expanded to other markets, they actually went where the diaspora went, where there is a lot of Philippine immigrants there. They first started there, and then by word of mouth, they picked up. So it's not easy to create a restaurant chain out of nowhere. So the existing guys have that way a high entry barrier. And Haidilao is special in the sense that they came with a very different, unique proposition. It is not something that you would get anywhere else.
Absolutely. Well, that's just about all the time that we have today. So Devi, thank you very much for sticking with us and answering all of these questions. Thank you everyone for being with us today. Do note that Devi is available for bespoke research requests or premium services. So please contact your Smartkarma account manager in this regard. And if you have any other questions for Devi, please email us at research@smartkarma.com and we will pass them along. Thank you, Devi, very much once again.
Thank you, Michael. Bye.
Goodbye.